Let's go over last in, first out. It's also referred to as LIFO. It's an inventory valuation method. And we're going to assume for this example that we're using a perpetual inventory system where the inventory is constantly being adjusted. Our example here, feel free to screenshot it or take a picture, is for LMNOP companies. We do have some beginning inventory, some purchases, and some sales. We're going to go over what the journal entries are for the purchases and the sales. And for most of these problems, it's either going to ask you for total sales, cost of goods sold, gross profit, and or ending inventory for the whole month or for a specific date. For this example, we're going to do it for the whole month. All right, let's go over the journal entries for this problem. In the first set of journal entries, we're going to assume that we are purchasing our inventory from our supplier. Let's assume also that our purchases are made on account. That means we didn't pay cash right away, but we're going to pay for it in the near future. You're always going to debit merchandise inventory as we are assuming that this is a perpetual inventory system. So we're going to increase our merchandise inventory for a certain amount, and that amount is based on the cost that you're getting the inventory for. You credit accounts payable because it's on account. That's going to be for the same amount as the merchandise inventory. The next set of entries we're going to record when we make a sale to a customer. Let's assume in this case that when we make the sale, it is on account. That means that we didn't collect cash right away, but we do expect that cash in the future. So if that's the case, we're going to debit accounts receivables. This amount right here is based on how much you sold the inventory for, the sale price. And of course, we're going to credit a revenue account. In this case, it's sales for the same amount. Next, we're going to debit cost of goods sold. It's also referred to as COGS or cost of merchandise sold. This is based off the cost that you got the merchandise for from your supplier. It's always going to be less, or the value is going to be less than your accounts receivable number and your sales. Your credit will be to merchandise inventory because in this problem we're assuming it's a perpetual system where the inventory is increasing and decreasing. In this case, it's decreasing because we just sold the merchandise. So there you have it, 2 sets of entries. If it's a purchase, it's the first set, and if it's a sale to a customer, it's the second set of entries. Now let's calculate sales, cost of goods sold, gross profit, and ending inventory. I like to set up a chart so it keeps things in order and we know where we are at all times. The first column is the date column. The second column is the purchases, where we purchase from our suppliers. The third column is the sales column, when we sell to the customers. And the last column is a very important column. It's the inventory column, which we must always update for every single transaction or date. So on January 2nd, for this particular problem, we had existing inventory of 10 units, and previously it cost us $5 from the supplier. On January 9th, we purchased some more. This time it's $15, but the supplier raised their prices to $6. So currently our inventory is made up of 10 at $5 and 15 at $6. On January 12th, we finally make a sale to a customer. This is where LIFO and FIFO become important. In this case, this is LIFO. So the most recent inventory, which is 15 at $6, is sold first before the older inventory. So we're going to take 12 at $6 from the 15 at $6. The 10 at $5 we don't touch because that's older inventory. And again, we're using last in, first out, where we sell the most recent inventory or the newer inventory first. In this case, it's at 12 at $6. So we still have the 10 at $5. And now we only have 3 at $6. That's our updated inventory. Now on January 18th, we purchased some more, this time 20 units at $7. Again, this is a case where the supplier raised their prices again. Here we're going to update the inventory column. Now we have 10 at $5, 3 at $6, and 20 at $7. Finally, on January 29th, we make one more sale for the month. We're going to sell 22 units. I'm going to repeat. You must sell the most recent inventory first, which is 20 at 7, and then 3 at 6. So here we're going to take all of the 20 at 7s, and then we just need 2 more at $6. We're going to subtract that from the inventory column. So 20 at $7 and 2 at $6. We're going to update our inventory. We still have the 10 at $5. And of the 3 at $6, we only have one of them left. So 1 at $6. Now your chart is complete. You've taken care of the date, the purchases, the sales, and kept track of the inventory being adjusted throughout the month. Now let's calculate the total sales. The total sales, you just have to go back to the sales column and see how many units you sold. In this case, you sold 12 units and 22 units. Remember that chart is based off costs from our supplier. Sales is based on the selling price. In this example, we sold our merchandise for $30 each. So we're going to multiply 12 times 30, which is going to give us $360. And then we sold another 22 units, again still at $30 to our customers, and that will give us $660. So your total sales for the month of January is $1,020. Next, we're going to calculate total cost of goods sold. Again, this is also referred to as total cost of merchandise sold. Here, you're going to take all the bracketed numbers, which represents inventory leaving because it was sold to your customers, and add those all up after multiplying each line item. So first we had 12 at $6. Then that will give us $72. Next we have 20 at $7. That equals $140. And finally, 2 at $6. That will give us $12. When we add all three values up, that will give us our total cost of goods sold for the month. That's going to be $224. Next, the problem asks for gross profit. If you remember, gross profit is found on the multiple step income statement for a merchandiser. First, you start off with sales, then you'll subtract the cost of goods sold, then you will get your gross profit. Since we calculated our values already, we do have our sales number, which is $1,020. And our cost of goods sold number is $224. You want to subtract that because cost of goods sold is considered an expense on the income statement. So after taking the difference between the two, you should equal $796. That is your gross profit for the month. Finally, let's calculate ending inventory. Ending inventory represents the items that you still have but have not sold to customers. Here, if you look at our chart, it's 10 at 5 and 1 at 6. So consider those two lines, 10 at 5 and 1 at 6. 10 at 5 will give you $50, and 1 at 6 will give you $6. Combine those two values, and your inventory that you still have is valued at $56 on your balance sheet.